Please remember, none of this is financial advice. I have a bias towards the XX Network because they're a sponsor of the show. In all chaos, there is a cosmos. In all disorder, a secret order. The government moves slow, but not in the case of Silicon Valley Bank. On Friday, it was announced that the bank failed, and by Sunday night, right before futures opened, there was a solution to the problem. That tells you the severity of the situation. Government is designed to be a slow-moving system. This had potential to be systemic, and everyone knew what was at stake. So much so that the president addressed the country about the matter.
And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them.
FDIC insurance is up to $250,000. Silicon Valley Bank had customers like Circle, Ripple, and other tech companies. Why did they break their own rules? Because when the genie is out of the bottle, it can't be brought back in. They have to calm people. Everyone with over $250,000 in their bank was watching this event closely, and they were panicked.
So it's hard to separate the effect of the jobs report on that change in expectations for a 50 basis point hike and obviously the SVB situation. I think it may have a bit more to do with the latter than the former, but I think this is clearly an example of something breaking. You know, the old adage of the Fed tightens until something breaks, and there's lags between changes in monetary policy, and the hiking campaign started a year ago, and this is one of them. Of course, as you all have been touching on, we don't know yet the contagion effect. There are unique circumstances around this bank with regard to the size of their investment portfolio, the fact that they weren't subject to liquidity coverage ratio. So it doesn't look like this. We can assume that there's serious contagion here, but it's also not surprising to see the industry getting hit from a market perspective, because things like bank runs are as much about psychology as they are things like liquidity and funding problems.
Banks are spread out with investments. They take customer deposits and then invest them. They invest through loans, bonds, stocks, money market funds, and they're constrained by how much investment that they have. How many customer deposits do they have? So when money shifts from smaller banks to bigger banks, it causes imbalances. The assets need to match the liabilities. It's been reported that the bigger banks' phones have been busy.
Combination of both. Right now, the narrative with investors in the banking sector is how punitive is this going to be in new regulations? Let's take the regionals first. There's going to be problems ahead here because, frankly, I don't think just guaranteeing deposits is enough to keep everybody with all of their money in just a regional bank. There's going to be diversification. Even in our own portfolio, we have now moved our assets across 5 different financial institutions. I don't care anymore to take risk and concentrated risk, and I think others will do the same. That's problem number one.
Every whale out there is thinking about where to put their money. Everyone with over $250,000 in their bank is looking for a place to park their money. Treasury yields dropped, and that means that whales were buying bonds. They exited the banking system and bought bonds. Bonds don't have the same amount of risk. Treasuries don't have the same amount of risk because it's from the U.S. government, and the U.S. government has a printing press.
Well, let me say it again. The problem is the bond market. And my prediction, I called Lehman Brothers years ago, and I think the next bank to go is Credit Suisse. And if that happens, Japan.
Because of its exposure to a lot of this?
Yes, because the bond market is crashing.
If Silicon Valley National Bank was happening right underneath the regulator's nose, what's happening in the rest of the world that's outside of U.S. jurisdiction? What's happening with Deutsche Bank and Credit Suisse? There's something big lurking in these waters. There's a new release to Speakeasy. It adds encrypted DMs, and you can control what channels you can be DM'd from. So now Speakeasy has private messaging right on the Speakeasy platform. If you're unaware, I have a Speakeasy, and the invite is in the description below. Everything that you write on Speakeasy is completely private. It's run through the XX network, and every message has their metadata stripped and mixed between 450 plus nodes.
Facts. And so at the end of the day, you can't protect yourself against idiot management in any sector, including banking. There's always a black swan swimming around in the lake somewhere, and you found it in Silicon Valley Bank. But here's where we're at this morning with this new policy. I don't care what bank we're talking about anymore. You as a depositor have no risk whatsoever. So what stops the idiot bank manager going forward from doing anything they want within the regulatory environment, taking as much risk as possible to get the stock price of that bank up? That's how they're compensated. This is going to create some very perverse acts by bank managers and crazy behaviors. And in the end, it's not a long-term solution whatsoever, because either you decide to nationalize the banks, in which case all of bank managers work for taxpayers as employees, just like giant utilities, or you let the private sector be the private sector. And within that, you have collapses by idiot managers like the Silicon Valley Bank, which, by the way, at the end of the day, would have only cost depositors around 5%. Those that were uninsured above
Nationalize the banks. Where have we heard this before? It sounds a lot like central bank digital currency arguments. Bonds are selling off, treasuries are selling off, everything's selling off, right? So if your bond sold off, that means the yield has risen. And that's what's happening, is yields are at like 5% because bonds sold off. Now, if you're a bank, you could go to the Fed and borrow for the full value of the bond today. You can get an overnight loan with the Fed, and they'll give you the full value of it to help keep you liquid.
Will the Fed continue to try to cool the jobs market now that raising interest rates month after month, basically, and meeting after meeting, has broken some of the banks? It's that simple. Well, the answer is yes. They will continue to use their interest rate tool. They'll run off their balance sheet, and this won't change anything. They'll make adjustments. Bank failures happen. If you go back to the year 2000 and take it forward, you've had about 560 bank failure. Niche banks get hurt if the niche they're in goes wrong. And that's basically what happened in the tech sector at this point.
Last week, we saw the Treasury Market get bid up. And that's because whales were shifting their money from banks and into treasuries. Now, the issue is inflation is high. So people invest in treasuries because it's guaranteed. They're guaranteed to get their money. The government has a printing press. They'll give you your money. And what's weird about all of this is that at the same time that we saw SVB start to drop, Bitcoin became parabolic. It shot right up. And you can see back here, it's pretty closely correlated to Bitcoin. Now, it's questionable because there was low volume during this period of time, and Binance sold $1 billion worth of BUSD. So maybe they're responsible for this pump. Nevertheless, I am very happy to see Bitcoin moving up at the same time there is a financial crisis. In the past, I've been wrong about this. The flight of safety was not true. During C19, market sold off at the same time. During 2018, when the Fed rose interest rates, the Bitcoin collapsed as well as the markets, right? So I'm optimistic to see that happen. It very well could be a fluke. However, I'm glad to see that. Now we know, when the system goes away, what are they going to use? They're going to use the CBDC/crypto type of system, and that's what the big reset is, right? The Great Reset. We're moving in from an old system to a new system. Now, treasuries got bid up. You could see even on this 30-minute chart, right? There's started this mini bull run. Now, the question is, will inflation come down? Because this will truly be the safe haven asset. And you're going to see the markets, just all of the wealth get sucked out of markets and brought into the bond market. However, it's not that crystal clear, because the there's an issue with inflation. Inflation is hot. So if you invest in a treasury that gives you 5%, but inflation's 5%, you really didn't do anything, right? So that's the reason why the bond market has sold off. Traditionally, when we've seen recessions, usually all the money goes right into the bond market, but not this time. This time is different. And with TLT, this is an ETF of bonds, right? Look, it's sold off, and you're right underneath this area of resistance. And, this could be interpreted as a bear flag or drop even further down. So where will money go if bonds continue to sell off at the same time we're having all these problems? And, the knee-jerk response of the market was to get into treasuries. However, that may not always be the case. And when treasuries get bought, it brings the yields down. The Fed is just following the bond market. That's all they're doing. They're not in control. It's the market that's in control. It's these banks that are interconnected and levered. They make the decisions. It's not the Fed. And the bond market is starting to bring this yield down. So if everyone exited and bought bonds, this yield would be at zero. And then the Fed would follow, right? And that would be the Fed pivot. Now, there's no guarantee that happens. The knee-jerk response was to buy bonds.
In the course of 5 days, 3 banks have failed in the United States, and those lenders were critical counterparties for a huge part of the crypto industry in the country. They served as a place where giants like stablecoin issuers Circle and the largest U.S. crypto exchange Coinbase once held deposits. These banks warmed to the crypto industry before any other banks really got on board, and some of them have remained the largest financial institutions to the crypto world before they shut down. Silvergate's announcement of liquidation was the most dramatic, given about 90% of its deposit base was tied to the crypto industry. But Signature also had significant exposure, and the bank's closure was far more abrupt in a surprise announcement late on Sunday night. Among its directors had been Barney Frank, a key proponent of the Dodd-Frank Act in the wake of the 2008 financial crisis that transformed the financial industry. He said crypto was a common thread behind the bank closures and a new and potentially destabilizing force to the financial system. But he also said that financial watchdogs were sending a message to get people away from crypto. He told Bloomberg that Signature was singled out to be the poster child for that message. Nick Carter of Castle Island Ventures had long been critical of the government's actions to stifle the crypto industry, referring to the efforts as the Operation Choke Point scheme to marginalize specific industries by choking off their banking access.
Crypto. I've said this numerous times, the crisis will be blamed on crypto and used to usher in crypto regulations. If they wanted to ban crypto, they would have already done it. This is going to be an opportunity for them to get rid of bad actors and provide a path forward for good actors. At the same time, you're watching the banks fail, and that's what the technology can provide, a way to replace the banks. They're also centralizing banks into bigger banks. The CBDC, the central bank digital currency projects, converge large banks with central banks. The problem stems from a lack of transparency. With CBDC, they could have transparency into the banks and know in real time where and when the stresses occur. The bond market is pricing in a black swan. There are no safe havens.
With this blender of forces, the tech market, liquidity, banking risk, and the Fed is in front of, behind, above, and beyond all this. The Fed's fingerprints are all over this. But at Silvergate and at SVB and at other regional banks, what happened in Northern California last week was prior to an asset devaluation, there was a loss of trust in the collateral in the banking system, which had to do with their measurement of risk. And a lot of that has to do with the ripple effects of FTX and Sam Bankman-Fried and the crypto exchanges and crypto-linked accounts, which were at Silvergate, or startup investments, yesterday's unicorns, which are now tomorrow's donkeys as these growth stocks and tech stocks head towards a mark cliff, which is the first stocks to get hit. And from my conversations with folks in Northern California, the VC environment was already talking to clients and folks about the risks in the collateral and in these tech stocks and these banks. And so
the Fed is blinked. They're allowing banks to borrow against their assets that they're underwater with. So if they bought a bond that's trading for $80, they can go to the Fed window and get $100 for it. What's going to happen to the Fed's balance sheet in the meantime? It's going to skyrocket. At the same time, they're supposed to be fighting CPI. They're supposed to be fighting inflation. So what happens when their balance sheet increases enormously as they're trying to fight inflation? It doesn't add much confidence to the situation. And that's what we're facing. The bond market is anticipating that the Fed's going to pivot. They're pricing in some type of deflationary event, so meaning all markets sell off. So the big money is pricing in some type of event where all the markets sell off and then the Fed pivots. Investors like Jeffrey Gundlach predict that CPI can go negative. When all assets sell off, it's going to drive the price of CPI much lower. So if we see some type of March 2020 event, that's going to bring inflation down with it, and then the Fed has justification to print again. This system is perpetual debt. It's the snake eating its own tail. It keeps having to expand. That's the point of this system, and that's why I'm in crypto, because I want to be outside of that system. At the same time, I'm seeing a lot of talk about CBDCs, crypto assets, crypto regulations. This is all a catalyst to bring that to fruition. You have all these banks failing, right? And the Fed doesn't have any transparency into it. That's what a CBDC does. You can see what's going on with the money, right? They can fundamentally change this entire system because the entire system is breaking down right now. In the midst of chaos, there is also opportunity. Thank you for liking, watching, and subscribing. If you enjoy content like this, please consider joining my Patreon, where you can watch these videos ad-free and early. If you dislike Patreon, I also have a website called dmjr.ghost.io. The content on Patreon is duplicated to this site.